Welcome everyone to today's webinar, Corporate Crime and Fraud, the Risks, the Red Flags, and Best Practices. My name is Glenn Patton, and I'll be the moderator for this webinar. Today's presentation is scheduled to run for 50 minutes with an additional 10 minutes for questions and answers. All attendees will receive a link to a recording of this webinar and the accompanying slides in the email within a few days. Please note that today's webinar is eligible for 1 CCS or 1 CES credit. Before we get started, I'd like to tell you how you can interact with us today. Throughout the webinar, we encourage you to type your questions into the questions box in the control panel at the right of your screen. We'll answer as many questions as time allows and can follow up by email if we run out of time. It's my pleasure to welcome and introduce Ms. Terry Cummings, Vice President of Sales for Roanoke Trade. As a licensed insurance broker, Terry brings over 36 years of experience working with companies engaged in international and domestic trade. As both a seasoned speaker and writer, Terry uses her knowledge to educate corporations and industry groups with presentations and articles on a variety of industry target topics. Terry loves to find new ways to shine a light on the common concerns of our industry. On a personal level, I've worked with Terry for 20 years, where she has been both a mentor and an extraordinary colleague to me. I've personally learned a lot from Terry over my career, and I have no doubt you will also learn just how passionate she is about teaching the industry. And with that, I'll hand you over to Terry.
Thanks, Glenn. I appreciate that. Good morning or good afternoon, depending on where you're sitting right now. I love to, as Glenn read, figure out ways to shine a new light on something that's not your normal presentation or topic. So hopefully you are interested, as I am, on the topic of corporate crime. Personally, I have a lot of recorded shows on my DVR of Dateline, American Crime, 2020, 48 Hours Mystery, all those things I love. So having this topic and putting on my metaphoric cap and hat like Sherlock Holmes gave me an opportunity to dig into this subject, and I sort of took it on like I was an investigator, and sort of, even though I'm familiar with the crime coverage and policy and have been involved in a number of different situations, learning more about the statistics from a global perspective was very interesting to me. I want you to understand that this is the first step in your education really about corporate crime. It's not exhaustive. We have a very little bit of time to talk about it, but I want you to take away just the idea of what the exposures are for your company, maybe how to formulate a policy if you don't have one already, and to make sure that you're protected as well as possible. So that's my goal, is just to open the door to this subject and help you go through the door and start your own process. A lot of the information and statistics I will be showing you comes from what is called the Associated Certified Fraud Experts, and an association of these thousands of experts that publish a report to a global report to the nations every couple of years. So the key findings from a global perspective are really taken from over 2,000 fraud experts who have investigated hundreds of thousands of actual cases, and they presented a very small slice of what is the potential loss out there on crime. So they looked at 2,690 cases of occupational fraud from 125 different countries and from 23 different industries. They looked at, it represented or resulted in over $7 billion in loss, on the average $130,000 for each one of those, with 22% of those cases over $1 million. As you can see, the median time frame this went on, the fraud was perpetrated, was 16 months, and the largest type of occupational fraud was corruption. Now, if, as there's a later statistic that they believe that about 5% of company revenue is lost to fraud. If they took that 5% number and applied it to the 2017 estimated gross world product, that would be 79.6 trillion is the total gross world product, and 5% of that represents $4 trillion. So nobody knows the actual loss numbers that are generated by crime claims, but it's a lot more than what these numbers represent right now. Looking at the United States, and this report actually goes through different geographic areas of the world, but just looking at the United States, you can see on the left-hand side the types of losses, and on the right-hand side, you can see in the United States how the losses were detected. Interestingly enough, corruption is at 30%, but that is probably the lowest number by loss by corruption than anywhere else in the world. The other figures go anywhere from between 36% and 62% that have corruption claims. Canada, for instance, is actually at 40%. So the United States is actually at a relatively a low number. So what is occupational fraud? It's an umbrella of different types of fraud, and it's divided into three main categories, which are corruption, asset misappropriation, and financial statement fraud. So corruption is defined as the abuse of a position of trust, making or receiving bribes, offering or receiving benefits. So examples of corruption are conflicts of interest, illegal gratuities, bribery, economic extortion, purchasing schemes, sales schemes, invoice kickbacks, bid rigging. Asset misappropriation is considered as the use of an asset, also money, for a purpose other than its intended purpose. Now, asset misappropriation is actually the most common type of fraud. However, it's also the least costly type of fraud. So that's kind of an interesting side note. Some of the types of asset misappropriation, which covers a lot of different types of schemes, include check tampering, billing, expense reimbursement, skimming cash on larceny and the payroll, registered disbursements. These are just some of the types of asset misappropriation schemes that are out there, and then where these all fit in terms of the median loss. As you can see, check tampering is the most expensive type of loss under this category. Financial statement fraud is this classic falsification of financial records and reports. So even though there's multiple subcategories under these understatements and overstatements, for more specific information and the ways that these misstatements are perpetrated, it basically comes down to two broad categories: net worth and net income understatement, and net worth and net income overstatement. And as asset misappropriation was the most common, yet the least costly type of occupational fraud, financial statement fraud is the least common yet most costly type of occupational fraud. So it costs more than you may think, as we talked about some of the key findings from the global perspective. A typical organization loses 5% of their annual revenue to fraud. In the United States, the average or median case of fraud is about 108,000, and then more than 23% of occupational fraud cases or losses are more than $1 million. So the other couple of interesting side notes is losses are twice as much without anti-fraud controls. But just having some anti-fraud controls reduces this number significantly. When an owner or executive commit fraud, it's also 10 times worse, meaning it's 10 times greater than when the employees are the perpetrators. How is occupational fraud committed? All right, so you can see the 89% is asset misappropriation, as we talked about, the most common. 38% corruption, 10% is financial statement fraud. Now, if you're any good at math, you know that those three don't total 100%. It's more than 100%. So why is that? That's because about a third of cases include more than one type of occupational fraud. So a case could actually include both corruption and asset misappropriation. Then you have your medium type of losses. As you can see, bears out what I said before. Asset misappropriation, the least costly, with financial statement fraud, the most costly. Further statistics show 80% of workplace crime is carried out by employees. 1 in 4 have committed or witnessed fraud or abuse, and 1 in 4 who has committed fraud has been with the company for 10 or more years. Only 1 in 3 who have witnessed workplace crime actually report it. So how is fraud initially detected? 40% come from tips. So going back to the 1 in 3 employees who witnessed fraud actually report it, I mean, still the largest success for actually detecting fraud comes from tip, and that doesn't necessarily mean it's a tip from the employee. An internal audit, management reviews, by accident, like many things in our lives, we find out by accident. Other account reconciliation, document examination, external audit, surveillance, monitoring. They're notified by law enforcement of the fraud. IT controls and confession. Obviously, confession being right along with the IT is not happening too often. Who reports occupational fraud? Well, about 50% are reported by the employee, 21% by the customer, 14% are reported anonymously, 8% by a vendor, 5% other, and then the competitor and shareholder owner are the last 2 categories of who reports occupational fraud. What are the types of organizations that are victimized by occupational fraud? Well, you can see that the majority is actually in the private sector, with public companies being second, government being third, nonprofit, and other. But you can also see that even though the largest percentage is by private company and certainly the largest loss, it's actually, the losses are not that much different between the other public companies and the government that also have relatively, whether 6-figure losses. Now, how does the size of your organization relate to occupational fraud risk? Interestingly enough, those companies with fewer than 100 employees on average have double the claim amount than a larger company. As you can see, 28% of these kinds of claims are generated from companies with less than 100 people, you know, and on an average or median loss of 200,000, and then it goes to 100 to 999, and then 1,000 to almost 10,000, and then 10,000 over. So it's actually fairly broad or fairly evenly distributed. It's almost 25% for each type. So that doesn't really seem to be one company size that has the greater risk for occupational fraud than any other. We will say that smaller companies have a higher risk of loss with just schemes that are related to billing, check and payment tampering, fraudulent expense reimbursement, skimming, financial statement fraud, and payroll fraud. So those companies with less than 100 have a tendency to have a greater risk in those areas. So it's interesting because, as we talked about, financial statement fraud is low frequency but high dollar loss, and it's often associated with public companies. I think that in the news we're more familiar with these kinds of crime stories as it relates to financial statement mismanagement or some corporate scheme that would impact the share of a company, their stock. But it's not just limited to larger companies. Financial statement fraud is also a small company problem. All right, So who's doing these kinds of things? You can't decide just by the look on their face. So what are some of the behavioral red flags that are displayed by perpetrators? And I want to tell you one thing before we go to this, is that 85% of all perpetrators exhibit at least one behavioral red flag, and 50% of all perpetrators exhibit multiple red flags. So here are some of the red flags that you should be aware of to help you try to assess what's going on in your organization if you suspect occupational fraud. Living beyond means, financial difficulties. I thought this third one was very interesting. We could understand the first two, that's pretty common sense, but an unusually close association with a vendor or a customer is a big red flag. Some people actually have no red flags. Control issues, unwillingness to share duties, divorce or family problems, wheeler-dealer attitude. I thought that was an interesting term of phrase, but kind of a vague, but I guess we can have our own definition of what that means. Irritability, the suspiciousness or defensiveness, addiction problems, complain about inadequate pay, excessive pressure from within the organization, social isolation, past employment-related problems, past legal problems, refusal to take vacations, complained about lack of authority. I remember from, years ago, I think I've been with Roanoke, 37 years, 38 years, something like that. And I remember early in my career hearing about that there was such an important thing to do is to make sure that employees took at least 5 days of vacation once a year, because one of the problems is if you're unwilling to take time off more than a day or two, then that is a red flag, because there is this concern that nobody finds out what's going on in your desk. So being away from your desk for at least 5 days is actually helpful to determine if anything that's going on that you've been trying to hide. So I thought that was interesting. A sizable majority of fraudsters were male. About 69% are male. Men also cause much larger median losses compared to women. So with men, the median loss is about 156,000 versus women who have losses of about 89,000. Gender distribution also varies by region. So in the United States, it's estimated that men are responsible for about 58% of all occupational fraud cases, compared to the Middle East or North Africa, where men are responsible for 92%. Interesting also enough that losses tend to increase with the age of the employee. So the largest percentage of people that commit fraud are over 36. So I thought that was interesting, because any assumption that younger people might be the responsible party, or even people that are new in their job, actually is not borne by some of the statistics. All right, so it's not just committing the scheme itself that you need to educate yourself about, but also these perpetrators have to conceal what they're doing. It's often just not just a one-time event either. As you can see, some of these, as the average duration is 16 months, but in some of the other studies that I've looked at, it can go on for years. So depending on the type of scheme it is. And understanding the methods fraudsters use to cover up their crimes can help you understand to design better prevention mechanisms and to detect the warning signs of fraud. So here are the top 8 concealment methods used by fraudsters. 55% created fraudulent physical documents, 48% altered physical documents, 42% created fraudulent transactions in the accounting system, 34% altered transactions in the accounting systems, 31% altered electronic documents or files, 30% destroyed physical documents, and 29% created fraudulent electronic documents or files, and then 27% created fraudulent journal entries. And then a little bit later, I'm going to talk about a few actual cases that I've been involved in. It is interesting, especially because in our industry, every industry is different in terms of what is the highest potential risk. And some of the cases that I have seen had a lot to do with padding or fraudulently altering documents and invoices. So I think this is a really important piece of information to remember is, that it also helps you to go, where do I look to try to figure out if there's actual fraud? I'm just telling you this real quick story. One of our customers, when they were notified, when they had figured out finally that was something wrong, and then they found out what happened, the way they actually came across it was they had quarterly executive management meetings, and in their executive management meetings, they looked at their financial, their incomes, their outgo, and they determined that while their income, the gross revenues were up, their profit margins were down. And when they realized the profit margins were down, they started to investigate why that was. And in that investigation is how they found out that one of the employees had been fraudulently creating charges and backing them out and taking the money. And it's just another way that having regular meetings and sort of taking a look at these numbers can also help tip you off if there's a problem. Now, if we look at our industries, as I said before, some of the reports were looking at 23 different industry sectors. And I chose two particular sectors that I felt was more representative of the people that are probably attending. How we can easily find a report that I referenced earlier. So in the transportation and warehousing sector, in the 83 cases that were looked at, the median loss for that industry was $140,000. Under professional services, of the 58 cases that were looked at, the median loss was $258,000. If you looked at both of these sectors and the types of cases and the schemes that were involved in those losses, you can see the billing, cash larceny, cash on hand, check and payment tampering, the corruption, expense reimbursements, financial statement fraud, non-cash payroll, registered disbursements, and skimming were all accounted for, and you can see where the largest areas of loss were for both of those industries. Now, if you want to look at it from departmental sourcing, which departments tend to represent the greatest risk of fraud and the greatest loss of fraud, you can see accounting, operations, sales. I mean, looking at accounting, which is a classic place, of course, you would think, and certainly I have seen where fraud has originated from, and not necessarily by the people in accounting. It's not necessarily the people in accounting that's creating or perpetrating the fraud. It could have originated by the work that's done in accounting. So, I mean, that's a very large cost of loss. You can see in the executive upper management, that goes back to a lot of that financial statement fraud. That's why those numbers are so high. Finance, purchasing, you can look at warehousing and inventory, information technology, manufacturing and production. These are all some of the larger loss areas in a company. So, is this all pie in the sky? Is this something that you don't really have to worry about? I can say for sure, even though it's not an everyday occurrence, In my career, I have certainly been aware and involved in a number of different claims which are occupational fraud related. I will say that in almost every case, it is extremely distressing to a company. Of any other type of claim that I've ever been involved in, except perhaps for the exception of employment-related claims like harassment, discrimination, those kinds of claims which can be a little emotional. The crime claim, the discovery that an employee has perpetrated a crime, is very upsetting to a corporation because it feels like a personal attack. And, you know, in many cases, it is a personal attack, directly or indirectly. So it's very personally felt. I don't think I've ever had an instance where a client has said, oh, well, I'm not surprised that they did it. In most cases, it's a shock. It is not who you think it's going to be. In some cases, it's someone that maybe an owner of a company has even helped personally and feels completely personally betrayed. So it's just not something that you can easily predict on your own. You've really got to look at how do you find and how do you detect this kind of thing happening, not just relationally, but all the other factors that you have to look at. So what I have seen definitely is document tampering. So back to the story I was saying a minute ago, this particular client had an employee where she started charging for white glove delivery services that were not being performed for their clients, but charged for them and then was able to adjust the invoice and take the difference. Another client of ours, their employee actually created falsified charges related to intensive exams, customs intensive exams. And in that particular case, he had to actually hold on to freight so that the freight wasn't delivered, therefore, you know, blowing his story. He had to then manipulate the freight so that it looked like it could have been delayed because of an intensive exam. So definitely fraudulent charges are something that we see in this industry that happen frequently. Theft of a customer's goods. We see collusion, especially with dealing with theft of customers' goods. One of the things that if you have a warehouse or if you have any kind of trucking or if you're doing that on a third-party basis, you will know that typically infidelity or of your employees or your agents is not covered under a warehouse liability or Bailey policy. So having a crime policy is very important because if you have employees or your agents that are stealing from your customers, you probably don't have the coverage for that in a standard warehouse policy. You would be looking at a crime policy for something like that. We also see companies posing as legitimate carriers and coming in and picking up cargo from the warehouse and taking it, and then all of a sudden, a legitimate carrier comes in and you don't have the cargo. That's a problem, not just from your internal theft, your infidelity by your employees, but also from your vendors. It's a problem for you. We also see deception. So not just the deception as I described with cargo, but very frequently now we're hearing about stories where it appears to be legitimate companies that you have a relationship with that are communicating with you and giving you instructions that are different than what the instructions were when you first had a relationship with them. So if you're familiar enough with the term phishing, knowing that in all of our email boxes, we see these emails that are not solicited by us and not from anybody that we know, trying to get us to do something, right? That's called phishing, where it starts with a P, PH. Spear phishing is something where it's actually it's posing as a known party to you, somebody that you already have a relationship with you. So it looks legitimate from your perspective, and they're trying to get you to also change some kinds of instructions. So obviously one of the most common things we've seen and the most difficult to recover from is when you get a communication that says, hey, comes from somebody you know, and we've changed our banking information. We now need you to send the payment that you owe us to this bank because we now have a new bank. And companies, and I'm talking about large companies, I'm talking about companies that should know better, I'm talking about people that have big accounting departments, good vetting systems. These are not just people that are not thinking or not have a good system in place. These kinds of deceptions are very sophisticated and look very legitimate. And so these are things that happen. Then people will send their checks or the ACH, their wire transfers, and then all of a sudden the people that they owed money to are asking them for their money, and then they find out, oh my God, I just sent them $100 and something thousand. And I'm telling you, it's usually in the six figures. It's not small amounts of money. This is a real problem, and these are things that happen in your industry because you're dealing with so many different third parties that are part of your business, whether it's your agent overseas, whether that is a customer, whether that is a trucker, whether that's a different carrier, whether that's a warehouse. You're dealing with a lot of different people that you are paying money to. It's very easy to be tricked into thinking that you're making a valid payment. So who can you trust? Well, the main thing is not to be so jaded that you think everybody has a guilty face, right? The majority of the people that you're doing business with and you employ are very trustworthy. But it goes across the board, meaning it can be an employee, but it can be a supervisor, it could be a manager, and it can be an owner or an executive. There is nobody that is safe from suspicion or actually not possible that they could actually perpetrate an occupational fraud. There's no class of employee or position that says, oh God, these are people that are not going to ever do that. Interestingly, only 4% of perpetrators of occupational fraud have ever been convicted of a fraud-related crime. So even though background checks of employees are an important screening mechanism, you know, you're not necessarily going to see a past history of people that have had this type of behavior. Only 61% of your employees actually have no negative issues from an HR perspective prior to or even during their perpetration of fraud. So 61%, the majority of your employees don't have any HR complaints, nothing that they've had to be disciplined over. So again, not necessarily a great way to try to detect who might be committing fraud. So what's the level of authority that relates to occupational fraud? As you can see, employees are the biggest group, but it's actually the smallest loss. And then it goes to manager, owner, executives, which is, again, that's 850,000 whopping loss, and others. 70% of the corruption cases, which is one type of occupational fraud, if you recall, involved a position and authority. 82% of those were male. Longer-term employees stole almost twice as much, with more than 5 years of employment, on average of $200,000. And then employees with less than 5 years of experience stole on average $100,000. Employees that have a year or less were responsible for about $40,000 on average. And employees that were with you 10 years or more, on average $240,000. So back to the earlier statement, it's not just young people. It's not just young broke people that are just trying to make a living. I don't know why that the larger amounts of fraud are caused by older people, and the only possible thought I could have would be maybe the sophistication of some of these schemes, and most likely probably it's the ability to hone their craft, not the first time they've done it. All right, for fraud that's committed by owners and executives, as we've already talked about, financial statement fraud is a problem for the owners, executives, and they create large losses. But if you look at the percentage of claims, it's really more corruption than anything else. So 65% of owners and executives involved corruption, and 27% involved financial statement fraud. Owners and executives also are more likely to collude with other people. Interestingly enough, collusion tends to be more costly than single perpetrated crimes. So one perpetrator on average may cost about $74,000. With two people involved in the scheme, on average, it's $150,000, and three or more people who are colluding in an occupational fraud scheme, it costs about $339,000. So the more people involved, the higher the loss tends to be. So how do you recover? Who recovers? Do you recover from fraud loss? As you can see, not a lot of people are recovering very much from fraud losses. 53% recovered nothing, 32% made a partial recovery, and only 15% recovered all losses. So we talked about who could be causing these incidents of crime. How do you detect them? What do they cost you? What do you look for? So risk management. Let's talk about the insurance aspect of covering a crime loss. There is a policy called a crime policy. It's like a lot of insurance, some insurance policies are standard, meaning that whatever, it's an ISO standard form, and all the policies have these forms, and all the policies are written the same. Crime policies are one of those policies that are not. They're specialty forms, and every insurance company may have a slightly different form. So it's really important to educate yourself on what's available, what your exposures are, and who offers what. So there's two different types of coverage triggers for claims policies. One is called a loss discovered, and one is called loss sustained. So loss discovered basically says that even if you had not had your policy in place, but you discovered the loss after your policy went into place, that it was going to pick up those losses even before you had coverage. And loss sustained has just to do with, it has to be sustained and discovered during the period of coverage. I got a call one day from one of my customers, and they said, what was the last, insurance policy we bought from you? And I'm like, I was trying to guess. I guessed wrong. And then I finally got, okay, crime, yes. So that was the way he announced that they had just determined that they have a crime claim, and had been going on for 6 months, and they needed to report the incident. Well, they'd been going on for 6 months, but they'd only had the policy for 2 months. But because they had a loss discovered policy, once they were able to support and to give evidence to the insurance company that they truly did not know this was occurring at the time that they did their insurance application, they actually did recover their entire loss, which was about $200,000. I mean, the good news is it was only 6 months, but this was the story I told you, where the management team met every quarter, and because they met so regularly, they actually were able to discover it sooner than later. Unfortunately, their CFO lost their job over this because it was something he should have caught, and so it was unfortunate that he didn't, because without that crime coverage, they would have been out $200,000 or more if it kept going on. So what kind of coverage were you looking for when you look at a crime coverage? So again, I said all policies are not the same. They're not going to cover the same thing. And they're also not necessarily going to be called by the same name. So each type of sub-coverage might have a little bit different name. So it's important not to look at the name specifically, but looking at the coverage they do cover. So employee dishonesty is a theft by an employee. Forgery or alteration, has to do with, again, forgery or alteration of documents, checks, that kind of thing. Computer fraud and funds transfer for fraud is interesting, because a computer fraud coverage means that a third party has hacked into your computer and it gives them access to transfer money or property. So again, it's a third party going into your computer and they're giving them access to steal from you. The funds transfer coverage is a third party that sends instructions to your financial institution. So for instance, somebody's gone into your computer or gone into the bank, got into the financial institution's website, posing as you, and giving them instructions to do something with your money, taking money out, transferring it, whatever. That's the two coverages. So it's important not to confuse those with other things that might sound similar. Theft, disappearance or destruction of money and securities, pretty self-explanatory. Theft of client's property. If you are involved in a warehouse operation, it is something you want to look at specifically, because again, as I mentioned, most warehouse policies and Bailey policies don't cover employee infidelity. So you really do need to look at a crime policy and in specifically this particular type of coverage. I will tell, well, we'll go into a little bit in a minute about what insurance companies look for when they quote crime, but it's something that your risk goes up, obviously, if you have a warehouse. Credit card fraud is really just taking a company credit card and using it fraudulently by a third party. It is not an employee stealing from you using the company credit card for his own personal gain, but it is a third party. Social engineering is a hot topic. It is a deception. It's being duped into giving something away. So it's not somebody that is robbing you or stealing from you or even going into your computer and transferring money. It's instructions that were given to you to do something and you were deceived into doing it. This is a increasing type of loss in the marketplace. It is also not automatically given to policyholders. It often needs to be discussed and added. Insurers usually have a sublimit for social engineering, much less than they will give you for your normal, like, employee dishonesty kind of coverage. The reason for that is whereas computer fraud and fund transfer fraud and some other things may have to do with something that's beyond your control, social engineering is looked at as a lack of due diligence, that you did not have good protocols in place, that your employees weren't trained properly, that they're not looking at red flags. So it's considered to be a lack of due diligence, and insurers are really reluctant to give much coverage for something like this. Crime coverage also include ERISA compliance. Well, if you have a 401k, you know that there is a compliance that either have a bond, ERISA bond, or a crime policy that covers your requirement under ERISA. The cap for ERISA is usually $500,000. Again, if you have a bond or the crime policy is $500,000 is the max. Identity fraud expense is not it's just expenses that have to do with the theft of your identity. It's not necessarily the actual loss, but in the investigation and in trying to repair your credit information. The virus and licensing violations have to do with a virus that was directed at you personally, designed to destroy or damage electronic data or computer programs. Vandalism also by an unauthorized person, an unauthorized reproduction of computer software by an employee. Those are all things that are covered under the virus and licensing violation coverage type. Cyber deception is a lot like social engineering. It can cover some of the same things, but it would be called cyber deception. So that's something that if you don't see social engineering, look for cyber deception. Erroneous transfer is also something that could be similar to social engineering in terms of it's something that's being deceived to give people money that they weren't, or property that they weren't entitled to. Policies could exclude, and many do, voluntary parting of property. So you see this voluntary property parting as a standard exclusion. So you would have to really buy back the coverage through the social engineering of cyber deception. Inventory shortage is something that typically is excluded, and so it also would be excluded under crime because you have to be able to say what happened to the goods, not that they just were here one day and disappeared and there's no evidence of where it went or how it went missing. I'm almost out of time, so I'm going to hurry through. Coverage and premium factors. These next couple of pages are saying, here's the kinds of information the underwriters look for. This is part of your application process, and all of these factors go into determining coverage that they're willing to offer and the premium and the limits and the deductibles they're willing to provide. So this is just something you can go back and look at, but certainly your operational protocol and your oversight is a big factor in their comfort of underwriting a policy for you. Here are some of the reasons why that people have crime claims. These are some of the breakdowns in what they, in their company: lack of internal controls, overriding existing controls, lack of management review, poor tone at the top, lack of competent personnel, other oversight. I will say one of our clients who had a crime claim of about $500,000 a few years ago it was a collusion between one of their station managers, a client, and possibly even a customer. And it went on for a period of time, and it was a lot of money. Went through that experience years later, and they had another experience whereby they violated their own policy of having two people and oversight over a bank account. The senior person just made that decision that he was not going to require a second person, and as a result of that decision, they lost over $2 million. Only $1 million was insured because they violated their own protocol. That's really important, is if you're going to have a policy that you follow through and you require everybody to adhere to it. Here are the most common anti-fraud controls, and these are things that just you look at yourself to decide, do you have some of these things in place? Code of conduct, external audit financial statements, internal audit department, management review, hotline. Hotline is actually a really good thing to consider, because one of the problems people have is feeling comfortable that they can tell someone that they suspect something. So having some type of way to report something anonymously is I think would improve your ability to get some cooperation from your employees. Data monitoring analysis and surprise audits actually correlated with the biggest reduction in both the fraud loss and the length of the fraud perpetrated. So those two things, the data monitoring analysis and the surprise audit, are two of the things that correlated the most with the reduction of loss. So, I mean, take all of that information and decide for yourselves what you can implement and, begin now. We also have, through the ACFE, a fraud prevention checklist that's available through the webinar handouts. You can go in and retrieve that. Also, we'll be sending a copy of this presentation and the recording, as well as the checklist, to you over the next few days. Glenn?
Thank you, Terry, for that very informative presentation. And to our attendees, thank you for joining us and taking the time to view our presentation. Terry's got some time here to answer any questions that you may have. So now is a good time to enter your questions using the questions pane on the right-hand side of your GoToView webinar. As Terry mentioned, there is a handout in there that's also on that same pane. You can drop down handout and download it. I'd also like to take this opportunity to let you know that a short survey will launch at the conclusion of this webinar. We do very much appreciate your feedback. Your answers help us to continuously improve our content for these webinars. So at this stage, please do type any questions. A couple, Terry, have popped up. First question would be, what department would this type of oversight generally be under?
It could be, it depends on how large your organization is, but it would typically fall under either risk management, finance, or perhaps even HR. I mean, if the larger the company, the more potentially departments you might have, like a security department. But certainly, I think between HR, finance, what I already said, finance, HR, and what else did I say, Glenn? I can't remember what I said. Those are the things that the more likely places for it to fall under.
Perfect. I mean, kind of in light with that, with you know, the various departments, you know, how can companies take this information and then adapt procedures for their company? And you know, you mentioned various departments that should be involved in that process. You know, what's the best way to start?
Well, coming up with your own list of what kinds of controls that you know you can implement and follow. And also, it's very important once you create that you communicate that. You also want to train your employees. You want to train your managers. You want to train your supervisors. You want to make sure that your employees understand that this is on your radar. I mean, that you're looking at this, that you're doing these kinds of checks and audits and things like that, because you want to deter people from trying to perpetrate something against you. So if you can make it a continual part of your conversation with your employees, letting them know that this is something that you're serious about, right then and there, that's a deterrent.
All right. Next question for you, Terry. You went over crime coverage. And, you know, I've got crime in my property and liability policy. Does that give me the same coverage as a standalone crime policy?
No, it doesn't. A lot of people, especially those who have 401k plans, will have a crime policy under their package policy, and that will help them with the ERISA compliance, and it will give them some crime coverage. But really, the most broad coverage are found under the standalone policies for crime or under the combined policies that include directors and officers, employment-related practices, fiduciary, things like that. Those are policies that are really specifically broader. The other thing to know is there can be a little bit of an overlap between cyber coverage and crime coverage, but they are not the same. They might provide some of the same benefits, but ultimately you do need both coverages to protect you from losses that are specific to each type of exposure.
And for those to be covered, Terry, is it required to notify the police generally? Is it, you know, sometimes policies will require prosecution to occur in order for the loss to be covered. Is that necessarily required in most of those policies you're referring to?
No. It's a good idea to report it, but actually a very, very small percentage, I think it may be 2 or 3%, actually report it to the police. And the reason that they don't is their fear of publicity. But usually what we see is people do report it. In most of the clients that we deal with, they do report it. In cases where it crosses state lines, the FBI gets involved, and we've had that as well. So it's important to get the authorities involved, especially when you're talking about some complicated and high loss situations. You also want to be protected in the next employer that hires a person. As we said, only 4% of people actually have been convicted of fraud. So, you know, that doesn't mean those people that weren't convicted didn't perpetrate fraud. They just didn't get, you know, reported.
Okay, thank you, Terry. those are all the questions that have popped up. If there's any last-minute questions, please feel free to type them in. Otherwise, we can go ahead and conclude this webinar. And I don't see anything popping up, Terry, just yet. Thank you so much, Terry, and thank you all for participating today. I hope everybody found this as informative as I did, and it's definitely a hot topic, and we certainly appreciate everybody participating today. And there are no more questions, Terry, so we'll go ahead and conclude today's webinar.
Great, thank you. Thanks, everyone.